Welcome to the Skillick Explains video and welcome to part 2 on my Back to Investing School series. Part 1 was all about profits. If you missed it, this one is all about assets, and part 3 coming up will be about cash flow. The 3 big terms that any equity investor needs to get their head around. Now, what's the point of this video? Well, basically what we're saying is, having understood what profits are in video 1, those need to be backed by assets and cash. So let's focus on assets in this video, worry about cash a bit later. So, first of all, a key distinction, all right? Businesses, like people, have things that they own, assets, and amounts that they owe, liabilities. So, if you're wondering about that, think about an asset. If you're fortunate enough to own a house, there's an asset. Oh, but if you've got a mortgage on it, there's a liability. So your wealth is the difference, the net amount. If you had sold the property, you'd have to pay back the mortgage before you could bank any money. Well, businesses are the same. They own things, they owe things, and the difference is called net equity or net asset value, just to give it a bit of jargon. All right. Now, what types of asset could a business have? Go back to the property for a moment, forget about the mortgage. Well, a property for a business will be an example of a fixed, tangible asset, just to give a bit of jargon. Fixed, well, properties don't tend to move, but fixed means long-term in this context, and tangible means you can kick it. Because businesses also own intangible assets, licenses, patents, royalty rights. You can't kick them, but they do have a long-term value. They contribute to the business's ability to generate sales. And then you've got another category of short-term assets known as current. And if you think about it, if I had some cash in my pocket, that's a current asset. I'll probably spend it within the next 12 months. It's not really long-term. Well, businesses have cash. They have receivables, amounts they're expecting to call in from people that owe them money. That's an asset. That's a good thing, as long as you get paid. And they carry a bit of stock. If they're a manufacturing business, for example, because they need to make stuff. They can't run on zero stock. So that's also an example of a current asset. And a key concept just to be aware of here when it comes to those long-term fixed assets that are not going to vanish, they're going to be used for years, plant, machinery, buildings, land, and so on, is the way that companies deal with them when it comes to preparing profit numbers is they basically chunk them up. So they make estimates. They say this asset should be good to help us generate sales for the next 20 years. So what we'll do is, rather than booking all the cost in 1 year and then nothing for the next 19, we'll chunk it out, depreciate it or amortize it, as they call it, over its useful life. That's just something to be aware of. It's a matching concept. Now, what should investors look for? Enough of the kind of back to school stuff for a moment. As an investor, why is what I've just said useful? Well, first of all, keep an eye out on valuation. There are quite a few different ways to value assets if you're a company. There's what you paid, the cost or the book value as it's called. There's what the market thinks the same asset is worth. All right, I mean, think about for a moment any asset you own. There's what you paid for it, maybe a while back now. There's what it's worth today, which could be above or below that if you think about it, also known as the fair value, to use accountant speak. And then there's what someone might buy it off you for tomorrow, the acquisition price, and that could be different again. Someone might be desperate to get that particular asset, that particular cricket bat you own, and is prepared to pay over the odds to complete their own personal collection. All right. So there are various different ways assets can be valued. And what this leads to is a warning sign, a red flag that things might be going wrong. You'll see this term used in the press a lot. It's called impairment. And an impairment arises where a company is carrying an asset in its books at too high a value, and basically the market and the accountants come in and say, not sure. I think the fair value of this asset is now below what you paid for it, and we want it marked down, literally impaired. When you see that word, it can indicate that a company is sitting on a load of assets that used to be worth a lot more, but in today's market are being marked down because they're worth less. Then watch out for what I call the bought versus created problem. If you try and compare two football clubs, for example, sets of accounts, you'll hit a problem, which is players that have been bought can be recognized as assets. This is a quirk of the accounting rules. Whereas if you grow your own squad, even if the market value that someone might pay for those players is the same, because they're superstars in the making, you can't recognize so much as a pound of them in your own books, because accountants don't like uncertainty. So they like recognizing things where there's a known price. They're not so sure about recognizing things where management are creating one. So watch out for that. Makes comparing companies in the same sector tricky sometimes. Same applies to software companies, by the way. Fourth, watch out for growth firms. Now, say watch out for growth firms. I like growth firms, but they often have very small balance sheets. It might be a team of experts developing something in a very cheap rented property well away from London. Well, there's huge value there somewhere, but frankly, the asset statement won't really capture it. And finally, the hidden nasty problem. Now, impairments are one indicator there might be trouble at a company. Hidden nasties are obligations, liabilities incurred, outstanding legal cases, for example, brought against the company. In order to find out how many of those there are that could whittle down the asset base potentially, you'll need to flick through a set of accounts, if you can face it, and look for contingent liabilities and the like. Won't go into too much detail here, but there are ways to just kick the tires on a company that's got a big asset base just to make sure that all is still well. Now, quite a lot of detail there. What I'm basically saying is understanding assets is an important part of investing. If you'd like to know a bit more than this video's conveyed, Killik.com/resources has lots of other related videos. My how-to guide on investing in equities is not a bad source of some of the stuff I've just talked about. And of course, there's our quarterly magazine, Confidant, where assets are often the subject of the stuff the equity research team talk about, for example.